Hi, good afternoon. This is Ben Lavine, Chief Investment Officer for 3D Asset Management. Welcome to the market commentary where we'll be discussing the events that shaped third quarter of 2016, as well as provide some outlooks that we share heading into the end of the year. Just some housekeeping items. If you have any questions, please feel free to enter them in the question tab within GoToWebinar. And we're also going to have a recording of this that we'll be making available on our advisor portal of our website. With that, go ahead and get started. Third quarter turned out to be a solid but uneventful quarter. Uneventful is good. I'll take uneventful, especially of what we experienced in the third quarter of last year. Those who recall the infamous August meltdown in the equity markets that led to a lot of dislocations. This quarter, in contrast, was, as I said, uneventful. Brexit happened and not much calamity occurred following the Remain vote. Global equities rose 5.3%, led by Asia and emerging markets. For the first time in a while, U.S. equities lagged the other major regions, although U.S. small caps rose 7.2% versus 3.9% for the S&P 500. However, much of the third quarter's market rally occurred earlier in the quarter, in July, right after the Brexit vote. Worries surrounding Brexit felt like the hysteria surrounding Y2K, in that Brexit's opponents' worst fears didn't materialize when a Remain vote prevailed. When the UK's economy didn't collapse, nor did the global financial system melt down over the vote, the markets took off. Japan also performed well following the Liberal Party prevailing in upper house elections and the Bank of Japan's commitment to steepen the yield curve by targeting a 0% rate for the 10-year government bond, which had been trading in negative territory. Following that, this is essentially a part of a broader rethink about what's going on with global central banks. They are rethinking negative rate policies due to the stresses that's being placed on global bank profitability and their appetite to fund long-term projects. So the pursuit for negative rates, we might start to see somewhat of a reversal on that if it's clear that it's causing more damage than good in the global economy. Back in early August, we wrote, with Brexit in the rear view and China no longer dominating macro concerns, the flight to safety trade may have run its course as more growth-oriented themes emerged to drive the markets higher. We again saw a rotation in factor leadership. What had been the leaders in the first half of this year, namely defensive yield-sensitive type strategies, had actually been the major laggards for this quarter. Pro-cyclical type of strategies such as value, small cap, and so forth actually did a lot better this quarter than they did in the first half of this year. The leadership continues to oscillate between risk on versus risk off, which is one more reason why 3D favors global diversification across not just regions and sectors, but themes as well. Towards the end of this presentation, we'll lay out a scenario where we can envision seeing interest rates leak higher due to incipient signs of inflationary pressures. Note, we don't see a 1994 or 2013 taper tantrum type of bond market sell-off with a spike in interest rates, but we think there are a confluence of things happening around in the global economy that could suggest a scenario of rates actually leaking higher, which would follow higher inflation expectations. Equity markets, as I said, were up for the third quarter, but they were actually flat in September, and U.S. equities were also flat in August. However, we did see more pro-cyclical segments of the market, such as small caps and emerging markets, do better. Both of those areas were up just over 1% for the month. Emerging markets outperformed the developed markets and are handily outperforming for the year. Emerging markets have benefited from a combination of low valuations, positive business sentiment, and a Federal Reserve that appears to be committed to a gradual pace of interest rate hikes. Financials took on the yellow jersey this month, having led all other sectors, apart from technology, over expectations that the Fed will raise rates sometime this year based on an improved economic outlook. The markets are, once again, sending mixed signals as bank profitability would be helped by higher rates, yet higher rates are being offset by the continued flattening in the yield curve, which would pressure bank profitability. We did momentarily see rates steepen but then flattened out later in the month. So we need to sort of see this consistent upward movement in the yield curve for it to benefit the financial sector. Healthcare had come under pressure over the month, although it did recover somewhat in September. This was mainly over Mylan Pharmaceuticals' EpiPen price hike, which got a lot of political flack and renewed investigations into pharmaceutical pricing practices. And we saw similarities of what's happening with EpiPen versus what was happening last year in the biotech space, where candidate Hillary Clinton started calling for a review of biotech pricing of medications. Interest-sensitive assets such as long-duration bonds and dividend-focused equities underperformed for the quarter following the Bank of Japan's announcement to target the long end of the yield curve, which amounted to a goal of steepening the yield curve between short and long-term rates. Utilities and telecom were down over 5% during the quarter, while U.S. REITs were down 1.3%. Back in our August commentary, we sort of rhetorically asked, have the global markets hit the wall? And we were speaking with respect to valuation. The U.S. market in particular, the march higher has been, with each new advance, is being led by different sectors. A narrow advance with plenty of sector churning underneath is one reason why active managers are struggling so much this year. The multiple continues to expand, partly due to a decline in earnings, the denominator in the PE ratio. According to FactSet, S&P earnings are expected to decline 2.1% for the third quarter, which will mark the first time earnings have dropped 6 consecutive quarters on a year-over-year basis. However, much of this decline has been driven by the energy sector as it works through lower oil prices. Analysts also expect revenue growth to turn positive in the third quarter and earnings growth to return in the fourth quarter. Analysts expect fourth quarter earnings to grow 5.2% from year-ago levels, and they are banking on a strong fourth quarter recovery to stem the slide in earnings as U.S. investors continue to look beyond the near-term earnings weakness in anticipation of outer period recoveries. Yet it feels like U.S. equities are struggling to advance further without clear signs of an earnings recovery. Certainly, a low interest rate environment remains supportive of high valuations, where an 18.5 forward multiple translates into 5.4% earnings yield. But the market is starting to run out of tailwinds to support further advances in valuation, such as the recent backup in global yields. So when will we hit the wall on valuations? Is it the 5th mile or the 25th mile during a marathon? Valuations are notoriously difficult to time, but with each step higher, investors must assess whether the incremental return is worth the ever-increasing risks, leaving little room for error should volatility start to pick up or spike due to some exogenous event. In September, we wrote a piece called Mission Accomplished, which was a title that we used the prior year when the Feds first started raising interest rates in the fourth quarter. We wondered then, as we do now, whether global central banks are finally accomplishing their mission, which is to bring inflation back into the system and stem the global deflationary tide that has plagued the world financial system and the economy since the 2008 financial crisis. This is a chart that shows the Bank of Japan's balance sheet when converted to dollars versus the U.S. Federal Reserve balance sheet. And I had to do a double take when I pulled in the latest balance sheet data, because the size of the BOJ's balance sheet is right at the level where the Fed is, despite Japan's economy being 1/3 the size of the U.S. So we don't see signs that QE is tapering off anytime soon. In fact, the balance sheets of Europe and Japan continue to expand. The question is what is the mix of bonds that are going to fuel further quantitative easing? And ultimately, what are the goals that are being sought for by banks as they seem to shift from one policy to the next, the latest one being the engineering of a steepening in global yield curves. So where do we go from here? There's a growing debate about the effects of negative interest rates, which emerged in early August, with those skeptical of negative rate policies pointing to rising household savings rates in Europe and companies hoarding more cash, which is the opposite of what you would expect with negative rates. Up to this point, fixed income investing amounted to a front-ending of central bank purchases as investors drove down European and Japanese rates further into negative territory. The 10-year U.S. Treasury yield dropped in sympathy, with global rates dropping from 2.27% at the beginning of the year to 1.45% at the end of July. And then we saw the steepening happen around the BOJ decision. However, the August-September steepening proved to be temporary as investors once again bought into the sell-off, helping push long-term yields lower than their inter-month highs. Dovish Fed comments following the no-hike decision in September, as well as the ongoing crisis of confidence surrounding Deutsche Bank, helped drive a rush into the safe U.S. Treasuries, German bonds, and JGBs. Although Fed funds futures expect a quarter-point rate hike at the December meeting, futures are barely pricing in one rate hike all throughout 2017, as opposed to the 3 rate hikes implied in the Fed's latest forecasts. So investors keep asking, when will rates finally rise in the U.S.? And our answer is when inflation starts to show up in Europe and Japan, leading to higher nominal rates in those regions. U.S. rates are inherently anchored to the global landscape and will not move in a vacuum. For now, global central banks continue to support equity and fixed income markets. Lower for longer remains the market's base case scenario. But we are seeing inflation expectations start to rise. Notice that they've been range-bound for the better part of the year, but they did rise from the post-Brexit lows. And the question now is whether the TIPS market versus nominals is going to start pricing in higher longer-term inflation expectations. They still remain well below 2%, but you're now starting to see some rumblings about how we could potentially, at least in the U.S., start to see higher inflation creep its way into the system. One key indicator then would be to look at how TIPS are being priced versus nominal bonds to get an indication of whether the market's starting to price in higher longer-term inflation expectations. As I mentioned as well, only one rate hike is barely being priced in for 2017. This assumes that we see a rate hike in December, which is looking more likely. And then following that, the question is well, what is the Fed going to do in 2017? By all indications, it appears that the Fed is going to remain on its gradual pace, will be highly reactive to the latest economic releases, and will more likely be prone to not raise rates than raise rates unless inflationary pressures are clearly staring at them to prompt them to be much more aggressive. And right now, the markets are saying the Fed is not going to be aggressive. In fact, we may not even see one rate hike next year. I suspect we will see 1 to 2 next year if the economic data continues to improve. But certainly, the market is pricing in a much more gradual pace than what the Fed has been communicating. Finally, we wanted to highlight this chart. This is a chart that I credit to Neil Dutta from from Renaissance Macro Research. And it does look like there's a bit of what I call econometric gymnastics here, where you're kind of fitting one curve on top of another to see if there's a relationship. But this curve makes sense. What this chart is showing is it displays the 8-quarter quarter-to-quarter change in productivity lagged 3 years versus the National Federation of Independent Business survey of labor quality and costs as the single biggest problem. Notice that the gray line, which is the NFIB survey, is rising post-2008 financial crisis, continues to rise as many businesses are indicating that labor costs and or quality are becoming a greater issue in their operating activity. So do you see the issue staring at you in this chart? Years of underinvestment in productivity improving capital spending is about to catch up with corporate America that would rather deploy capital into more shareholder-friendly activities such as share buybacks. After riding the wave of cheap, abundant labor post the 2008 recession, labor costs and quality are becoming real issues to the point where companies must now mix shift their production pace to using more capital versus labor in order to maintain their competitive edge. Productivity will make a comeback, but it will involve kicking, screaming, and scrambling on the part of corporate America to make up for years of underinvestment. A new cycle of capital spending followed by global fiscal stimulus programs in response to the global populism driving the 2016 election season would not only extend this long in the tooth business cycle, but could also lay the seeds for future inflation. Labor costs are already making their way through the production channel, and the fruits of renewed capital spending will take time to bear out. Hence, we may be entering a period of long-term interest rates leaking higher as they track long-term inflation expectations. We put this as a distinct possibility, but not as our base case as we head into 2017, because ultimately we're following what the markets are pricing in, but that all might change. So far, the market doesn't see an inflation problem. As I said, Fed funds futures are barely pricing in one rate hike in 2017, but we're inclined to go with the market until there's a shift in expectations. However, we wouldn't necessarily rule out changes to the model portfolios to reflect this potential for a rising rate environment, even if we suspect it's going to be more like a leak than it is a taper tantrum. What are the key issues heading into the election? Well, obviously it's the election. Certainly what we've been seeing with this political race this year following the Brexit vote is that populism is in vogue. Now the establishment candidates might ultimately prevail as populism kind of gets more sober, but there's always that risk that this year may be different. It certainly was in Britain. So markets seem to be more reactionary to every new headline or every new poll that comes into place. Our stance is that you shouldn't try and position portfolios around the election, around a specific electoral outcome. Because one, it assumes you can correctly forecast what the political outcome is, and two, suggests that you can correctly forecast what the asset price reaction is going to be to that outcome. Both are highly fraught with uncertainty. Following the election, we're looking at whether the Fed is going to raise rates in December. That's pretty much a given at this point, apart unless we see some abysmal employment release that comes out between now and then, which doesn't look likely. But the question will be is as to what their forward comments and their forward outlook will be going into 17, whether they still anticipate seeing, call it 3 rate hikes in 17 versus the one that the market is pricing in. And a lot of it may be centered around how optimistic they feel about current economic trends and so forth. Fourth quarter earnings and the outlook are also obviously important, particularly because fourth quarter is now the period where analysts expect to see meaningful earnings recovery in U.S. stocks. And if we don't get that, then that means one more quarter of negative growth rates. But again, it doesn't look like that's going to be the case given that much of the oil price weakness that had been a drag on earnings as well as the strong dollars behind us. Finally, then there's the issue of the Brexit fallout and Eurozone banking system. Eurozone banking, I'm referring to Deutsche Bank. Quite a bit of fireworks in September when the Justice Department came out with a proposed settlement or proposed fine of $14 billion for Deutsche's mortgage lending practices prior to the financial crisis. Obviously, this is a high number, and in a negotiating stance, you always start with a high number and then try and position around that. But the markets were freaked out by this because Deutsche Bank is already on a precarious capital state given their high leverage and lending activities. And they certainly can't or would have a difficulty absorbing a $14 billion fine from the Justice Department. And so the markets once again started pricing in concerns about Deutsche Bank, and those haven't been resolved. The big question now is whether if Deutsche Bank did get into meaningful trouble or not, whether the German state would come in and help them with a capital raise or inject taxpayer funds into Deutsche Bank. That doesn't seem likely given that this is an election year, and it would be contradictory to the stance that the German government has been taking with other Eurozone banks that have faced similar troubles. So there is some hair that's going into the fourth quarter, but for the most part, it looks like we are on a stronger trajectory in terms of the global economy. And if we do see meaningful earnings recovery and deflationary risk continue to dissipate, not just here, but overseas, those could be potential healthy backdrops for a continued rise in asset prices. And with that, we'll see if there are any questions. One question is will traditionally conservative strategies like holding more bonds than stocks continue to be conservative? What should I do with my older and retired clients? 4% withdrawals don't seem prudent. This is kind of a good lead into our retirement income solution that we offer through Income Conductor that basically addresses the 4% systematic withdrawal approach that many advisors had been adopting for retirement income distribution. We don't think that 4% systematic withdrawal is a viable approach long term, and with the new Department of Labor fiduciary regulations, it seems like there needs to be a more substantive plan for retirement income than just 4% systematic withdrawal. But to answer the question, we think a conservative portfolio still makes sense in this environment for near-term segments, particularly ones that can't afford to what we call taken on sequence of return risk, meaning volatility. But we think that positioning for portfolios in income can mean different things. What we've seen this year so far has been, an aggressive chase for yield, trying to extract every bit of income, whether it's taken on more interest rate risk, such as long maturity bonds, or taken on more credit risk, such as high yield. In our fixed income ETF managed portfolios, we believe we offer a healthy balance between risk as well as return, because we feel that the risk that we are taking for is well compensated for. But I would say that in general, a number of things could happen if credit spreads start to widen because of concerns about, what's going on in the financial system, or, if we have another energy market type of scare like we saw last year, that's going to lead to some losses in portfolios that are sort of reaching for yield. Another scenario is similar to what we saw in September, where just a slight backup in interest rates led to a big sell-off in defensive bond proxy type of sectors such as utilities and telecom, and it just kind of highlighted that where yields are right now and how far they've been pushed down. There's a lot of duration sensitivity out there, and you can see it manifest itself in the way of higher, more magnified losses in things like utilities, telecom, and REITs. As I said, we envision a scenario where we could see rates leaking higher, which would certainly put pressure on these sectors and so forth. But so far it's not the base case, because that's frankly not what the market is pricing in at this point. Second question is, do you think you'll be moving into or out of foreign or EM stocks in the near future? I can't say for sure. Right now we are overweight international and emerging market stocks in our portfolios, which has been beneficial to our performance. But that was partly on a valuation, as well as it looked like that some of our global macro barometers earlier in the year had started to stabilize. I could see a scenario where, particularly in emerging markets, that recovery in an asset class that has just underperformed for the last 5 to 7 years, I could see that recovery and starting to gain some steam, and that would certainly make it more attractive for us to shift more into that space. But keep in mind, we do run global risk control portfolios. We're not the kind of shop that would aggressively move in out of, say, the U.S. market and into emerging markets on a tactical basis. We are anchored to our global equity benchmarks, because that is what advisors retain us for, is to provide that global equity risk profile. We have one more question. What is 3D's best mix for global stocks for the next 3 years, specifically address Japan, emerging markets, and developed Europe? Just kind of a follow-on question from the previous one. I would say at the margin, I feel most comfortable with emerging markets, and if anything, I would think of funding that out of Japan and Europe. I think there are still some ongoing issues in both of those regions, especially in Europe, not so much in Japan. And if anything, the risk reward looks more attractive. So in a way, I could see us, being more sort of barbelled between the U.S. and emerging markets and less exposed to Japan and Europe. So with that, thank you for attending. If you have any follow-up questions, please feel free to contact us. We are available, and just as also a reminder for advisors that we contract with, we are hosting a separate portfolio review webinar on Thursday. If you haven't registered for that, I certainly encourage you to do so. Thank you for joining us, and we look forward to further correspondence with you.